Let's attempt to wrap this week, and wrapping the week. Usually it's a 10-minute phase on Friday at in the show is plenty of time. I feel like to define what's happened this week. I don't know if we have enough time in an entire day of programming to try to make sense of this. But we'll do our best. Wanted to start out with a poll. Actually, we asked you on StockCharts TV and also on our YouTube channel over the last couple of days. What basket of stocks do you think will perform the best over the next month? And I gave you four choices: the Fang Man trade, which is sort of the Fang, the MAGA sort of mixed all together: Facebook, Amazon, Alphabet, Microsoft, and Nvidia, all of those. Biotechs, things like Regeneron, Biogen, and so forth. Banks were number three: JP Morgan, Bank of America, Citigroup. And then energy: Exxon, Chevron, ConocoPhillips. And the results are in. Over half of you, just over half, said the Fang Man trade, that big defensive mega cap tech and communication services basket of the stocks that have been leadership for quite a while on a relative basis, for sure. A quarter of you answered biotechs, things like Vertex and Regeneron, and 10% each for banks and energy. And it's interesting, I guess depending on when you answered that poll during the week, your answer may have changed dramatically. And I don't have the transparency to know when when the votes were given and where they lean to. But over half of you, I think, picking what is a pretty decent bet. I think what's been impressive with stocks like Microsoft and Apple, we've highlighted on this show, they've continued to do well. And even when the price has pulled back, on a relative basis, they continue to outperform. And, again, looking at the XLK and just the long-term trend of it, when charts like that just continue to chip away on a relative basis, and in upswings and downswings, they do well. It's not a bad play, especially if you're nervous. That makes sense. If you're optimistic, they've been leadership names as well. The relative strength have been pretty consistently positive. So I will assume you've come to that conclusion looking at the charts, and for that, I say job well done. Within biotechs, things like Regeneron have consistently been at the top of the scooter rankings. Regeneron right now, the third on our entire list of 1,000+ large cap names. So decent bet as well. Banks and energy, I think, are a tough play, to be honest with you. And if you would vote one of those, you're expecting that this sort of rally that we saw up until the end of this week, up until Thursday, that would continue. You'd continue to see banks and energy that have been, really emerging as new leadership, but now have corrected. You'd assume that outperformance would restart. I don't know if I'm getting that feeling looking at the charts. Let's look at some of these together and see if your opinion would change over the course of this wrap the week segment. Just to reset on where the day finished and where the week finished, the S&P closed a little bit higher to 1.3% higher to 3041. So if you look at just the day, this is yesterday. Just look at that slow and steady downtrend, just consistent down move. We gapped higher today, but then pretty soon, by about 11:30 a.m., we were right back at the previous close. We gapped up, but then gone all the way down and round trip to the lows. We actually poked below there after lunch. Around 2 p.m. was the low of the day, around 29.90. So we did rally into the close. What's encouraging about that, as we talked about in our last mailbag segment, that's when a lot of institutions tend to come in and put in some larger orders. So institutional flows are usually what you're getting a sense of at the end of the day, and certainly feels more net buying than selling going into that close. But the destruction's been done. Yesterday's sell-off certainly put us into a different feel altogether. And I just know from the commentary that I follow and my own thoughts, it's very easy to start thinking about downside risk when you've been ignoring it, when the market just continues to go higher. Now we've seen a bit of a chink in the armor, and the question is what's next. Mid caps and small caps down. Up a little further. So small caps finished up 2.5%, which is pretty nice. It was actually a nice run higher. Also bottomed out around 2 p.m. and came up to finish a little stronger. The Nasdaq 100 finishing up as well, 0.8%. So underperforming the S&P, but overall hanging in there all right. Bond market's a little weaker today. They were up pretty significantly yesterday. Choppy move today, but finished more toward the lows with the TLT down almost 1%. 10-year yields up to around 70 basis points or 0.7%. Commodities essentially flat. Gold was up just a token amount, but overall relatively mild. Had rallied pretty strong out of the open, but then came off and finished more toward the lows of the day, but higher than yesterday's close. So commodities not a huge issue. And it's interesting, thinking about cryptocurrencies. We don't talk about cryptocurrencies a ton on this show, but I think it was worth noting yesterday when risk assets like equities were down significantly. At times, I know people have talked about Bitcoin and digital assets as more of a safe haven of sorts, like the dollar that you'd flock there. But worth noting that Bitcoin was actually down pretty significantly right along with stocks yesterday, up a little bit and retraced a bit of that today, but again, finished the week weaker rather than stronger. Let's look at, actually, let's go right to the Mindful Investor Live chart list to finish off our discussion here, wrapping the week. So, with our Wrap the Week section, the idea is to take stock of where we've evolved. And we talked about this market trend model a couple times this week, because on Monday, with the big gap higher, this is where Monday opened around 320 on the spiders, which was, up again from Friday's close. And I made the comment that if the week ended right at that moment, the long-term model, which has been bearish since March, which was just before the market lows, mid-March when it finally turned negative, this would have flipped it back positive if the week had closed Monday midday. By the end of the week, and Thursday is what really killed it, actually remained in a negative signal, remaining below the zero line. So it's really, really close. These are close to crossing. And depending on what long-term weekly moving averages you use, it may or may not have turned positive this week. But for my model, for what it's worth, it remains in the negative camp. So would have to wait until next week at the earliest. I look at it every Friday to formally update it. And what's interesting is I've not updated the chart yet, but short-term indicator actually turned negative because the slope of the histogram separating the two weekly PPOs just turned negative this week with the down close. So right now it's long-term bearish, medium-term bullish, short-term bearish, which is actually about right. That actually feels about right with the outside week that we've seen here. That's when you have a big up week, an outside week, meaning higher high, lower low, but you have a down close. It wasn't quite a bearish engulfing pattern on the spiders, which would be the close would need to be below the open from last week. So it's not quite that negative, but still is, I would bucket in the negative candle chart sort of category. And certainly from a bar chart analysis, this is called an outside week with increased range, higher high, higher low, but a down close after an up close. And that suggests short-term weakness, telling you the next couple of weeks are going to be more corrective. So I feel pretty good about a model that says short-term weaker. The medium-term trend, which is this coming out of the March low, is still stronger. That makes sense because we haven't retraced enough to feel that that's negative. And the long-term trend is still telling us we're in overall bear market territory, which is about, I think, how things feel, to be honest with you. Now, the real, I think the validation of that sell-off on Thursday cannot be overstated because, as we continued higher, we become overbought. What we talked about on the show was just, this is now, an overbought condition. That on its own does not tell you that the uptrend is over, but it suggests that we're, near that point where you'd start to look for some sort of topping signal. We got that going into Wednesday's session. When you have the pullback, you have the RSI coming out of the overbought region. We then sold off, obviously, significantly yesterday. Today and yesterday, pushing the daily S&P below its 200-day moving average. Yesterday, we actually closed below it. Today, we closed back above it. So I don't think you can count that as a valid breakdown of the 200-day. At this point, it's serving as proper support. I think for a lot of people, myself included, holding above the 200-day, holding above the 3,000 level is pretty meaningful. As long as we can do that, I think that medium-term trend remains positive. If we would start breaking that, which would have to obviously be into next week, I think that's where you have to be a little more concerned about further potential downside. At this point, though, I think at this point it's serving as support. We've traded down about to the level where you'd anticipate support in a quick pullback, which was again long overdue by any stretch of the imagination. Just to jump around a bit, and sorry, in this sort of environment, I feel like my mind is spinning with things that would be great to review. This is the NDX, the NASDAQ 100. This was one of our 3 and 3 yesterday. Give me just a second. I'm going to switch to a weekly macro chart, which is this one. The concern I have looking at the broader charts, and over the weekend, I'll love to look at individual stock charts and see how many come up. But I have a feeling with a lot of tech names and a lot of the leadership names, we're going to see a similar divergence on the weekly chart here. We've had a higher high in price, a higher close on the NASDAQ 100 the last couple weeks, but we now have a lower RSI. And I think, it felt like we could still be going higher. I think the pullback that we saw this week could indicate that, this is sort of the short-term top in the RSI. So you have higher highs in price, lower peaks in the RSI, which is very toppy. That's sort of what market tops have tended to look like. It's not 100% totally this is what always happens, and is a perfect example that I'll show you the end of 2014. You had the bearish divergence here, among others, which was higher highs in price you can see lower peaks in RSI. The market actually continued higher for another 6 months. Even though we had that pullback in mid 2015, we actually went to new highs at the end of 2015 before the end of that pullback. So even though while that whole stretch was corrective, you know, in the end, you sort of resolved higher, and it was more of a time correction than a price correction. So, you know, so again, it's not saying that that means we're going to retest the lows or anything like that, but it certainly suggests that we've gone high enough for this phase, and expecting further weakness in price would be certainly a legitimate expectation based on that that broad divergence. But if you look at all the broad asset classes, and NASDAQ 100 is one of the few that's moved to higher highs. The average chart looks more like this, which is the Russell 1000, the New York Composite, the Dow Transports, the Russell 2000, which is small cap stocks. You can see they all have, you know, come nowhere close to their highs from earlier this year. The S&P 500 is the same. So the NASDAQ Composite, the NASDAQ 100, those are the two that have already made higher highs. Interesting to see that they've gotten that divergence. And now you have a non-confirmation with the broad indexes, the S&P not making a higher high while the NASDAQ Composite did, which again sort of nets out to more of a weaker tape than stronger. This did not update for today some of these breadth measures, but I just want to finish off looking at some of the breadth readings. You know, here we're looking at the cumulative advanced decline lines. Yesterday's sell-off was certainly very, very sudden. This short-term uptrend that we've seen since the March lows, I think, still in place, right? If you look at a trend line taking the lows, we're still overall making higher highs and higher lows. All we've done here is begun the process of making what arguably could be a higher low. We'll have to see what next week holds. So overall, that's not flashing a warning signal yet. So breadth, I think, still remaining fairly constructive. You know, a lot of the new highs that we saw going into this week have sort of dried up. So you can see the increase in new highs on the S&P 500 going into this week. You can see how it's come off, as a lot of stocks obviously pulled off of their 52-week highs. To wrap up, though, here I want to focus just on this form of breadth, which is the percent of stocks above their 200-day and above their 50-day moving averages. We've looked at this chart a lot, and a lot of my guests in the last couple of weeks have referred to a chart kind of like this, which is looking at how many stocks within the benchmark are confirming what we see with the overall market. So the S&P breaking above its 200-day in the last couple of weeks, you know, now testing it from above. What is the average stock doing? And what you saw is it went from a single-digit percent of stocks above their 200-day to almost 70% of the S&P above their 200-day. That has very quickly come down to 36%. So we've lost about 30% of the S&P that had been above their 200-day, now closing back below it, going into Friday session. So that sort of change is obviously very, very key, and it shows you how many stocks are in that similar bucket to the S&P, just recently breaking above the 200-day and now coming back a lot. They're right at that key point. So, you know, whether stocks like, you know, those stocks that are making that switch, whether they're able to recover into next week and go back above, or whether this is the beginning, if that line continues down, showing you more stocks breaking down into next week, I think that'll tell you certainly a sign of some weaker breadth going into next week's trading as well.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.